I'd like to thank Clemens and Wojtek for their generous comments in introduction. They've given me a challenge that I doubt I'll meet trying to live up to them. I'm delighted to be back at CESifo. I've visited here a number of times, had delightful visits in the past. Hans Werner and I ran 2 conferences here, joint with NBER in the past, and I've attended other conferences here, and it's a pleasure to be back. I'm also delighted to be giving a lecture in memory of Richard Musgrave. I studied with Richard as an undergraduate and learned about the long tradition of public finance in German, Scandinavian countries, and Richard had a big role in stimulating starting work in public finance in English-speaking countries, because even though there was a large past literature, it was normally in German, and US economists are parochial and hadn't been able to follow it. And so I was heavily influenced by Richard's lectures, and it'll be reflected in the talk I give today as well as in much of my past research. The topic I chose to give today is on the role of the corporate tax. The motivation for the talk in part came from the recent tax reform in the US. This reform was probably the largest, at least dealing with corporate taxes, that have occurred in decades. And there are several key pieces to it. This is only part of what happened. One was a dramatic cut in corporate tax rates, a 40% cut from 35% to 21%. There was also a 20% cut in tax rates for most non-corporate firms. Another key piece was a shift from depreciation of capital investment to expensing. A third was to shift from worldwide taxation of multinationals, where in principle they're taxed on their income accruing throughout the world, to a territorial treatment where they're simply subject to tax on their profits accruing within the US. Now, this was a major reform in the US, but there were similar changes that have occurred in other major countries. On average, corporate tax rates have fallen in half since around 1980 among developed countries. The US shifted away from worldwide taxation, but so did the UK and Japan a few years before the US, and continental European countries had been using a territorial treatment for many years. So the US was a laggard in this shift away from worldwide taxation. Now, in spite of these dramatic changes in the tax law, of which the US was a laggard, there's, to my mind, been a neglect of corporate taxation in the optimal taxation literature. It's focused on the personal income tax, the rate structure, the tax base, but very little on how the corporate tax should be designed and how it should interact with the personal tax. I mean, I fear that this has led to less structured debate on policy, since there's not an academic literature to appeal to think through how the tax should be designed. I'm doubtful that academic research has that much effect on the policy debate, so probably more important is that the lack of this literature makes it harder to teach about the corporate tax. And so this may be as well a problem with the existing literature. So the objective of my talk is to try to pull together what I'll call the folk wisdom on the role of the corporate tax. I couldn't find a good reference in the past to lay out how the corporate tax appropriately would be designed to fit into the overall tax system. And because of that, I had been working on a paper trying to pull together ideas where the invitation to give this talk came in. And so I chose to describe today some of the ideas I've been trying to put on paper for a project. Now, even if I couldn't find a good reference from the past, I think a lot of these ideas are part of the folk wisdom, are well known. So if I'm simply describing things that you know already, I apologize, but I think that reminding ourselves about the key pressures faced in the design of corporate taxes is useful given the rapid changes that have been occurring in the design of the corporate tax. When I say there's little reference in the past literature, I mean, there are papers, but forecasts for how the corporate tax should be designed are all over the map. Let me start with, in honor of Musgrave, from his lecture is named, a paper that he did with F.Z. Domar decades ago, in the 1940s. What he and F.Z. presumed in thinking about the corporate tax is that when businesses are started, new ventures are very risky, and seldom are new firms able to share their risks with the financial market more broadly. And because of the high risk they face, it's intimidating to become self-employed, and that the high risk premium that most individuals would attach to the risk they face discourages innovation and economic growth. What they then argued is that a corporate tax or tax on new businesses more broadly will help absorb some of the risk, both the gains and the losses, and share those risks with taxpayers more broadly, and through that risk sharing, make a new venture less intimidating and encouraging entry and growth. Now, it could discourage capital investment as well, but if there were expensing or a shift to more generous depreciation deductions in response to the higher rate, that can be offset. Now, a response to that, really a comment on the Domar-Musgrave paper, was one by Diamond in the mid-60s, almost 25 years later. What Diamond said was what was omitted from the Domar-Musgrave analysis was the stock market. And to the degree that firms have shares traded in the stock market, then the market should allocate risk efficiently. That would be true without a corporate tax, but would be true with a corporate tax as well. And so the presence of the tax wouldn't improve the allocation of risk if we had expensing or adjusted depreciation deductions to offset any changes in the corporate rate. Then there are no real effects of a corporate tax, and the rate's irrelevant. In further work that Diamond did with Merles a few years later, they said that if economies are small, then a small open economy should not tax the return to capital. Is an optimal tariff argument. The optimal tariff in a small country is zero, and small relative to the capital market in this case. And so among these three papers, one's arguing for a high tax, high corporate tax. The first of the Diamond papers says that the rate is irrelevant. And the third paper said we should have a zero rate. So hard to make a case from this literature that policy is good or bad. Now, any theory has to make assumptions, and is focusing on some implications but ignoring others. And two key assumptions in a lot of this literature are the following. One is that the return to corporations, the tax base, represents the return to capital invested in that firm. So that any return to labor is fully deductible from the corporate tax base and then taxable under the personal tax. And the return is returned to the capital in that firm and not potentially shifted to other firms or other countries. Another assumption in this prior literature is to focus on the corporate tax in isolation and not to think about how it interacts with personal tax. And so what I'd like to do today is to think about what happens when we relax these assumptions. And as Wojtek forecast, I'll be focusing on the threat to the tax system of income shifting from the corporate tax base to the personal tax base, or from corporations to non-corporate firms, or between corporations in one country to their subsidiaries abroad, and how the tax system should be designed to try to deal with this threat of income shifting to the tax system. Now, to try to highlight what I think is the importance of income shifting, let me give a number of examples of ways in which it can occur. First, thinking about opportunities available to an entrepreneur. Sergey Brin in Google, Mark Zuckerberg in Facebook. They have an idea for a new firm and try to pursue it, and in these two cases, it turns out to be extraordinarily profitable. If all return to labor were paid out deductible under the corporate tax, then they would have received huge wage bonus payments taxable under the personal tax. Instead, those returns were largely retained within the corporation, and as has been seen, documented by Gabriel Zuckman and others, largely shifted abroad and escaped taxation entirely. So that what we see is high value of these firms, and the return that the initial entrepreneurs get takes the form of capital gains and in principal corporate taxes, but largely avoided through shifting the profits to a tax haven. Another example, workers in at least a closely held firm, if they're paid in wages, taxable under the personal tax, deductible under the corporate tax. If they're paid in shares, what the tax law says is that, well, the shares should be valued based on its market value, and again, taxable under the personal tax, deductible under the corporate tax. But for a closely held firm, there is no market. That's what we mean by a closely held firm. And in that setting, at least in the US, what the IRS has ruled is that we're not going to try to judge the value of these shares. The business can assign whatever value it wants to these shares, and almost always it's $1 per share as a par value. And so there's virtually no deduction for labor expense, higher corporate profits, but no labor income to the workers. When they sell the shares, it's all capital gains. So that's shifting the labor income from the personal tax to the corporate tax. Other examples is shifting between corporate and non-corporate firms. At least particularly in the 1980s, there was a major tax shelter industry in the US. What it was successful at doing was to shift expenses into a non-corporate firm owned by investors in high brackets. They could deduct these losses against their other personal income, saving a lot in personal taxes. But then profits were shifted to the corporate tax base, taxed at a then lower corporate tax rate. An example of how this was done is an oil and gas drilling partnership, where when the firm starts, it's digging a hole in the ground. It's expensive to do, and those losses that are incurred in the time are losses borne by high bracket investors, deductible against their other income. If and when they find oil, then the firm is sold to a large oil corporation and then taxed at the lower corporate tax rate. And the whole partnership sector at that time ran a large loss because of activity like this. I mean, the main type of income shifting that we face now is by multinationals shifting their domestic profits abroad into tax havens and escaping taxation that way. So the outline of my talk is to think through how the corporate tax should be designed, and a commonly used phrase is as a backstop to the personal income tax, but in particular focusing on how it can deal with the threat from income shifting. I'll do this initially in a closed economy setting, where I think the argument is a part of the folk wisdom, things that I grew up with as a public finance economist, and then shift to an open economy setting where the threats we face now become harder to deal with. Now, the story of the corporate tax as a backstop to the personal tax, should resonate in developed countries, the US, Germany. It doesn't make much sense in thinking about tax policy in developing countries, where often the corporate tax looks very similar to what it does in the US and Germany, similar tax rate, similar tax base, but in a setting often with no personal tax. And so the question in that context is, how should the corporate tax be designed in isolation from a personal tax? So I'll spend a few minutes later in the talk trying to readdress these questions, but in the context of a developing country. And then, as I have time at the end, think through directions for tax reform relative to the law we face now. Now, the key assumption that I'll make, trying to simplify the presentation, is that the tax system should be designed to maintain production efficiency. If you have production efficiency, then the tax system shouldn't distort the choice of investors whether to operate in the corporate or the non-corporate firm, shouldn't distort how workers are paid, whether it's reported under the personal tax or the corporate tax, or domestically or abroad. So it would avoid any gains from income shifting. Now, the argument for productive efficiencies, typically attributed to work by Diamond and Murley's in the 1970s, what they argued is that on distributional grounds, we certainly tax labor income, trying to shift the tax burden from low-skilled to high-skilled. We may choose to tax return to savings. We may have taxes on particular types of consumption goods. Later literature tried to find assumptions under which a labor tax alone would be sufficient, but in their setting, any of these could be used. But what they did conclude is that given whatever labor or capital is supplied to the market, given whatever goods are being demanded in the presence of various consumption taxes, the production using those factors to produce those goods should be done efficiently. And so that's the assumption I'll be using in this talk. There was a subsequent paper by Emmanuel Saez trying to rethink the assumptions needed to justify this assumption of productive efficiency under an optimal tax system. And in his paper, there are two key assumptions, one dealing with equity issues, one with efficiency. If we start with a neutral tax system, the question is whether that in fact is optimal. And the assumptions that this paper highlights, one is that there's no difference in expectation of the earnings ability for an individual given their observed labor income, whether the income came from a work for a corporation or work for a non-corporate firm. That information doesn't add anything to what's known already from their reported labor income. The other assumption dealing with efficiency issues is that if we were to tax this income, there may be an equity gain, but an efficiency loss. The assumption is that the efficiency loss is the same whether that income is being generated in a non-corporate firm or a corporate firm. So that per se doesn't affect the elasticity response. So those will be the maintained assumptions I'll make. Work I did with Wojtek will question some of these assumptions, but I'll maintain them for this lecture. And so focus on efficiency considerations, trying to maintain a neutral tax treatment of income regardless of whether it's corporate or non-corporate, reported under the corporate tax or the personal tax. Now, any paper makes simplifications, and let me be upfront that I'll be focusing on the design of the corporate tax. More generally, there's a choice of the tax system more broadly, personal tax and corporate tax, that being chosen simultaneously. Yes, that's underlying the discussion I have here. What I'll be assuming is that the personal tax was designed appropriately, and then focus on how the corporate tax should be designed. Yes, these choices interact. If the corporate tax has been designed to lessen income shifting, then the observed tax base under the personal tax is a better proxy for the individual's earnings ability, and the personal tax can be used more effectively to shift the tax burden from low-skilled to high-skilled. And so that interaction between these tax bases is implicit in the discussion, but I'll be ignoring it in the presentation. Another simplification is I'll ignore any market failures, whether it's Lemon's problems, signaling issues, agency costs, market power that firms might have. There's an interesting literature out there dealing with how the tax system might be designed to offset a number of these market failures that would focus on specific sectors where these issues are more prevalent. I'm going to assume that away to be able to focus on a setting where markets work. In a lecture like this, it's hard to use notation. All of it's here. It's just convenient in presenting results to use some. And what I'll use to denote the marginal tax rate on labor income under the personal tax is the parameter M. We have a progressive personal tax, and so it's going to vary by tax bracket, but for any given individual, the notation is M. Tax rate on capital income, there's a long debate in the tax literature about how capital should be taxed. Many papers arguing it shouldn't. But for purposes of generality, I'll allow a tax on return to capital, focusing to begin with here on portfolio investment or capital invested in the non-corporate sector. We'll assume that the tax rate is denoted by N. Now that's a simplification of a complicated tax law, but it's there to avoid many complications. And finally, the effective personal tax rate on income accruing within the corporate sector and ultimately received either in the form of dividends or capital gains, I'll denote by G. Now, that's brushing under the rug a lot of complications. How quickly are capital gains realized, short-term, long-term? How do we think about taxation of dividends? There's a new view, there's signaling models, agency models. So there's a lot. I could spend the whole time and only be able to introduce this literature. And I'm brushing all of that under the rug and assuming we have some implicit tax rate G, less than M, on income accruing within the corporate sector. Now, before I even begin to talk about taxation of corporations, I should spend a little bit of time thinking about the taxation of non-corporate firms. For these firms, what's reported is the total income earned by the firm. It could come in part from the labor inputs of the owners of the firm and in part from capital invested in the firm. I'm assuming we'd like to tax the labor income at one rate and the capital income at a different rate. But from the tax return, there's no differentiation between what's coming from labor, what's coming from capital. And so the question is how we impose these differential rates without opening up opportunities for income shifting. There's more than one way to do it. I mean, one approach is used under the dual income tax in Scandinavian countries. What is used, I think, successfully enough in most other countries is the following. To begin with, all the income accruing to a non-corporate firm is taxed at the same rate as labor income. So that the only way to avoid that tax is to try to generate deductions from the non-corporate tax base. The deduction I'll focus on here is depreciation. And depreciation depends on what's paid for the capital. It's hard to come up with easy ways of income shifting to affect that. And I'll assume that that's not something that can easily be manipulated. So that avoids gains from reclassifying labor income as capital income. But the question is how we maintain the desired tax rate on capital income, given that the firm's overall income is taxed at this high personal tax rate appropriate for labor income, and that can be done through choosing the generosity of depreciation deductions. Just to, I mean, for the tax economists here, I think this should be straightforward, but not everybody here is working on taxation. So let me add just a brief note here. There's work by Hall and Jorgensen done in the 1960s trying to think through how the tax system affects the equilibrium marginal product of capital. And what they argue is that the after-tax, 1 minus m times the marginal product of capital, f of k, should equal the opportunity cost to the investor. What they have to put up to finance this capital is the dollar initially to buy the capital minus the present value of tax savings from depreciation deductions. In their notation, Z is the present value of depreciation deductions and the tax rate. And what they could have gotten on that amount of money is the rate of return R net of the personal tax on capital income, rate N. And in addition, capital depreciates, so amount D has to be reinvested each year to maintain the capital, but that qualifies for yet further depreciation deductions. So that's the Hall-Jorgensen formula for the return to capital, given the tax system. To have productive efficiency, what we want is that marginal product of capital should equal the return pre-tax that could be earned elsewhere, the interest rate plus the depreciation rate. And so the claim is that Z can be chosen to satisfy this productive efficiency condition. And natural results, if we have no tax and return to savings, then this value for Z that solves this is allowing expensing for investment. If we tax the return to capital at the same rate as we tax labor, then we want economic depreciation. That's traditional result in the tax literature. If we do have a non-zero tax return to capital different from the tax rate on labor income, there's a value for Z that comes out, but it depends on the values for M versus N. That's varying across investors. The depreciation rate doesn't vary across investors. And so we try to find something that minimizes the damage, but there is damage in the choice of a depreciation rate. Now I should note already that the recent tax reform we had shifted to expensing, but did not eliminate personal taxes and return to savings. There was no effect on the taxes on interest, capital gains under the tax bill. Those are still positive, and so we don't have neutrality in the taxation of capital income. The law also cut by 20% the tax rate on the profits of a non-corporate firm, and so rather than being taxed at rate M, it's being taxed at 0.8 M, giving workers an incentive to become an independent contractor, distorting the choice of how production occurs. So even in this setting, before we get to the corporate tax, the tax reform created problems. Now, what about the personal tax treatment of, different from income from corporations? Many forms of income generated within the corporate sector are paid out to individuals taxable under the personal tax, wages, interest, rents, royalties, and taxed the same as income coming from other sources. And so here, no problem. Where the problem arises is income that would ultimately be received as dividends or capital gains, where together the effective tax rate is this assumed rate G less than M, creating an advantage to activity within the corporate sector relative to non-corporate firms or individuals simply working and investing their portfolios in the market, distorting activity favoring the corporate sector, and within the corporate sector creating an incentive not to pay wages, interest, rents, royalties, to retain money within the firm to take advantage of the lower rate G rather than having it taxed at rate M. So distortions to how production occurs. So the role of the corporate tax to begin with is to impose a supplementary tax on corporate income to compensate for the low personal tax on this income, to serve as a backstop to their personal tax. Now, any income, the wages, rents, royalties, interest that's already taxable under the personal tax should be deductible from this tax base since it's already taxed appropriately, so the tax is net of those deductions, tax base. And then the tax rate should be chosen to achieve productive efficiency, neutrality, so that the income to begin with is subject to the corporate tax, new notation T, and what's left net of the corporate tax is still subject to this tax rate G, and the corporate tax rate to achieve productive efficiency should be set so that the double taxes owed on this income are the same as what would have been owed if it had shown up fully under the personal income tax at rate M. So by notation, this combined tax rate will be T star. So that M equals T star is what's needed in order to achieve neutrality. Now that's talking about labor income. Capital income, for the non-corporate sector, the approach used to differentiate capital versus labor income was to tax all the income at rate M, net of depreciation deductions, but then to choose the generosity of depreciation deductions so that the net tax return to capital is at rate N. If we design the corporate tax so that the overall tax on corporate income is also M, then that same depreciation rate ensures that the return to capital generated within the corporate sector is also N. So no additional complications there. Now, the rub is that we have a progressive tax system, but one corporate tax rate. And so M and G vary across investors, they vary across time. And so no matter what rate we choose for the corporate rate, there'll be distortions. Some individuals will be in a personal bracket below the corporate tax rate. They have an incentive to have money paid out of the corporate sector into the personal tax base. Others in a personal rate above the corporate rate, and they have an incentive to retain money within the corporate sector to escape their higher personal tax. And so the challenge in choosing a corporate rate is to trade off distortions going in both directions. And at the tax rate that minimizes these distortions, as you raise the corporate tax rate, you have less money pulled into the corporate tax base for investors in high brackets, but more paid out to investors in low brackets. And if these net effects cancel out, then you've chosen the right rate. Now, there's little empirical evidence to help guide that choice. I did have one paper with Joel Slemrod that Wojtek mentioned, looking at the degree to which money shifts between the personal and corporate tax base depending on relative tax rates. One thing we found there is that the responsiveness to that rate difference is much higher for investors in high brackets than investors in low brackets. So that suggests that the corporate rate should be close to the top personal tax rate. Still a trade-off, so not quite, but that's about as far as we can go. It's harder to judge exactly where the rate should be. But I think that this trade-off is well understood within the U.S. Treasury. There have been times in the past when the Treasury has gone to Congress asking for an adjustment on the corporate rate, arguing that's out of line relative to what this argument would say, in order to come closer to what this argument would lead to. Now, this focus on the corporate rate, well, effective rate on corporate income, T star, relative to M, is central to a lot of specific literatures dealing with the corporate tax. It shows up repeatedly in different contexts within the tax literature. Obviously, a choice of organizational form. If you're corporate, you're taxed at T star. If you're non-corporate, you're taxed at rate M. And so that choice of organizational form depends on that tax difference. If you're looking at the allocation of capital, where is it tax favored? If it's within the corporate sector, it faces tax, it has the same depreciation deductions, but net of depreciation in one sector is taxed at rate T star, the other sector rate M, and so the distortions arise from that rate difference. Income shifting, that's what I focused on, that depends on the rate difference. Use of debt versus equity, here it's a bit more complicated. In most of that literature, the interest income is taxed the same as labor income, and so it's this tax rate difference, T star minus M, times the interest rate. That's the tax savings from having the interest deduction in the corporation, even though the interest income is taxed to the individual. Here, I'm assuming that the interest income is taxed at rate N. If it's fully deductible under the corporate tax and N is less than M, then there's a distortion here. And to avoid it, the interest should be only partially deductible under the corporate tax, contrary to what we see. So economic distortions there. And further, because the M in these other cases is the personal tax of the owners of the firm, here it's a market implicit factor incorporated into market prices, and a lot of investment comes from pension funds that are untaxed, and they may trade much more actively than individuals, and so the effective N given market pricing could be close to zero, leaving open a large tax distortion here for any given corporate tax rate. I should emphasize that all of these distortions were made much worse by the recent tax reform in the US, which cut the corporate rate by 40%, opening up large gaps between how income is taxed in the corporate sector compared with how it's taxed in the non-corporate sector or for individuals directly. And so on this ground, hard to make sense of what's driving the tax reform. Now let me turn to an open economy. When I first was in the profession, most papers ignored open economy issues entirely, easy simplification. A few years later, there'd be a paragraph at the end of a paper trying to speculate about how things would change in an open economy. And now I think you're throwing out the bathwater and the baby if you don't take into account open economy issues. This is the dominant consideration. So let me turn to that now. The new form of income shifting that enters in an open economy setting is the ability of multinationals to shift their income into a tax haven. But even ignoring that, there are a lot of new complications I'll try to lay out in trying to administer a tax system given that income is accruing in multiple locations. So the question still is, how should the tax system be designed to maintain productive efficiency? And in looking at this, I'll proceed step by step, focusing first on inbound capital flows, foreign portfolio investment, foreign direct investment, and then turn to outbound investments and how each should be taxed. For inbound investment, I've already cited one of the key papers, the Diamond and Murley's paper, and one implication of their productive efficiency result is that if a country is small as a price taker in the world capital market, then the optimal tariff on capital should be zero. Now, even if a country is not small and so has an incentive to impose a tariff, this is a prisoner dilemma, if you want. Each country may think it gains at the expense of others from imposing this tariff, but jointly they likely would gain from an agreement such as the WTO in the case of tariffs on goods to reduce these taxes towards zero. In the case of withholding taxes paid on cross-border payments of interest, dividends, capital gains, we do have equivalent international agreements with bilateral tax treaties reduce these withholding taxes in many cases, if not to zero, to a minimal tax on these cross-border payments. But the Diamond and Murley's argument applies not just to withholding taxes, which are small, but also to corporate income taxes. Income generated on investments in a country coming from abroad shouldn't be distorted, so shouldn't be subject to corporate taxes as well as to withholding taxes. So the argument is that any shares in a firm owned by foreigners should be untaxed. Now, two ways it could be untaxed: a zero rate on the profits accruing to foreign investors or expensing. And the arguments I made before about the threat from income shifting says we want expensing so that any money shifted into the firm from domestic sources, from workers who are paid in a way that shares rather than wages, is still subject to the same tax rate. So it says that to the degree that there are foreign shareholders in GM, General Motors, then the firm should have expensing even if they have other income accruing to other shareholders being subject to depreciation. And the same for BMW. If it invests in the US, there are some US investors owning shares in BMW. There should be depreciation for the income accruing on those shares, expensing for the income accruing on shares from non-US investors. Now, this distinction based on the nationality of the shareholder is totally outside the tax literature. There's nothing that I've seen in practice pushing towards that type of distinction based on the nationality of the investor looking at the corporate tax base. So the question is, why not? Because I think that the arguments I've made in a domestic context are understood at some level within the in treasuries, and yet there's no reflection of this extension of the policies in an open economy setting. Now, speculation of a couple of reasons why we don't see this. One is that firms don't always know the nationality of shareholders. It's not just that shareholders may invest through a Swiss bank and have anonymity. They can invest through a Vanguard or Fidelity fund, and the firm knows that these dividends are being paid to a Vanguard fund, but they don't know the nationality of the underlying investors in this fund. But this lack of information could reflect simply the current tax law. There's no need for the firm to know this. But even if the firm could get this information, and we tried to differentiate tax provisions based on the nationality of the shareholder, it says the after-tax profits accruing on a share vary by the nationality of the investor. So the dividend payout rate should vary by the nationality of the investor. giving firms the right to pay different dividend payout rates depending on who's owning the shares is asking for trouble. I mean, the price elasticity of shares likely varies across categories of investors. So we haven't seen anybody attempt this direction of reform. But I think an even simpler explanation for why we don't see it is that if we simply had foreign direct investment and no foreign portfolio investment, we had full home bias. I mean, at least from the US perspective, we're close to it, less so in continental Europe. Then sufficient simply to differentiate policy based on the nationality of the firm. So treat foreign subsidiaries located in the home country potentially different from domestic firms. Now, even that, I think we don't see. I mean, China did have a lower tax rate on foreign subsidiaries relative to domestic firms. India had a higher tax rate on foreign subsidiaries, but I've never seen policies hinting at the variation that I'm describing here. And so the question is, why not? Now, one potential explanation is that the implicit tax rate on capital embedded in market prices is basically zero because so much savings comes from pension plans that are the active participant in the financial markets. And if n equals zero, then a country should be choosing expensing. We now do have expensing by law. I had prior work that Wojtek mentioned saying that even when we didn't have expensing, capital was virtually untaxed given all the different provisions within the tax law. And so that may be. We have expensing for all capital and don't have to differentiate between foreign and domestic. What about outbound investment? On outbound portfolio investment, foreign direct investment, to have neutrality, we should have the same tax provisions if the shareholders own capital abroad as they do at home. If the provisions are different, then we're distorting how production occurs, introducing inefficiencies. So this means for domestic investments, we tax corporate income at this rate T star to achieve neutrality. It says we should tax income accruing abroad the same way. Tax rate T star on the income accruing each year on shares owned by domestic investors. Now that's true whether it's investment within a foreign subsidiary of a domestic multinational or simply shares we buy in a Europe fund or a world fund. If it's owned by a domestic investor, then to that degree, the firm's profits should be taxed under the domestic tax at this rate, D star. This again, no hints of this that I've seen any place in the tax law trying to impose a corporate tax on the accruing income on shares owned by domestic investors. Now, why not? An easy answer is that under international tax conventions, a country doesn't have the right to tax a foreign firm simply because it has domestic shareholders. So clear why we don't see it. But even if we didn't have that restriction on domestic tax law, if we allowed countries to impose tax on a firm to the degree that it had domestic shareholders, then firms would be filing taxes in virtually every country in the world. Hard enough to deal with one country's tax provisions, but to deal with the law in many countries would have huge costs. But this, as with the discussion of inbound investment, these complications go away if we have full home bias, so no foreign portfolio investment. Now all it says is that the home country should be imposing tax at rate T star on the foreign subsidiaries of domestic multinationals. Now that is what worldwide taxation allows. And so it fits within this framework if we can assume full home bias, and not such a bad assumption in the US context, less good in Germany. But worldwide taxation almost always, when it was used, imposes tax not each year, as happens with domestic firms, but when profits are repatriated. Now, if the tax is only imposed when profits are repatriated, what incentives does it create? If we tax the return to savings, when the profits are repatriated, any future earnings are subject to this tax at rate N. If the earnings are kept abroad, they escape this tax. And so there's a tax incentive to let profits build up abroad, postpone repatriation, and firms can be very patient and take full advantage of this. And not only defer taxes to the degree that the corporate tax within the host country is less than the domestic tax, they can shift the profits to a tax haven and avoid any taxes until the money is finally repatriated, in which case the full tax burden falls due. But keep postponing repatriation. And so the result is that the effective tax rate on activity of multinationals can be pushed towards zero, not just in their foreign activity, but in their domestic activity, because these profits can be shifted abroad. That gives a large tax advantage to multinationals over domestic firms within each economy. Now, this advantage from deferral would be avoided, in theory, if we didn't tax return to savings. Now there's no difference in principle repatriating early or late. It's the same argument as wages are taxed the same as money invested within a pension plan if we don't have a tax return to savings. It's taxed now or taxed later on this present value, but the overall tax burden is the same. So we still want to impose this tax D star when funds are repatriated, but that's now sufficient. Let me, for purpose of time, skip this. So where the argument stands so far, if we had full home bias, not a bad assumption for the US, and no tax return to savings, an arguable assumption, then worldwide taxation seems to achieve productive efficiency. But one other, we do have expensing now and still have a lot of profits sitting abroad. I had close to expensing before and again had years worth of profits sitting abroad. So one other implicit assumption is that the effective tax rate on corporate income T star is constant. I've mentioned that corporate rates have fallen in half over the last 30 years, and so clearly a bad assumption. They had been more stable in the US, but we had a tax holiday in 2005, allowed repatriation at a trivial tax rate, and done once can happen again. And so firms were anticipating and lobbying hard for another tax holiday, and they were rewarded in 2017 with a shift to a territorial treatment. And so anticipating that, they again have the incentive to accumulate their profits abroad, sitting in a tax haven to avoid all tax, waiting for the next tax holiday to bring all these profits back subject to a trivial tax. And that again gives multinationals a huge tax advantage relative to domestic firms, undercutting the domestic economy. So pulling together results, what we seem to need for worldwide taxation to do a roughly decent job of maintaining productive efficiency are these three assumptions: no tax return to savings, full home bias, and a stable corporate tax rate. Now, in the past, I think pre-1980, in the US, full home bias, very good assumption. Tax rate stable, it had varied between 46 and 52%, but remarkably stable. N equals 0, well, a lot of savings were in pension plans. And in terms of market pricing, that may have been a good approximation. So that the US may have done an okay job with this tax system prior to 1980. More pressure within Europe, and the European countries largely had already shifted to territorial taxation. But at this point, these assumptions clearly don't hold. Corporate taxes have fallen a lot, and firms could continue to expect further cuts and maintain money abroad, waiting to repatriate until those cuts occur. So that UK, Japan, the US, the last large holdouts using worldwide taxation have all shifted away from it. These assumptions no longer holding is not a big surprise. What we shifted to, and what European countries largely had already, is a territorial tax system. Now, if worldwide taxation that simply leads to this accumulation of profits abroad, repatriated years later when the tax rates are trivial, then there's no revenue collected on this activity, but there still are these distortions pushing firms to rearrange how their activity is done to avoid these domestic corporate taxes. Under a territorial system where you're only taxing the profits accruing domestically, then these distortions go away. You may lose a little bit of revenue, but not much. There may be a slightly bigger advantage to multinationals relative to domestic firms, but I expect in hindsight probably not much happened in response to the shift to a territorial tax treatment in itself in the UK, Japan, US. I think these other changes were more important. But it's not solving the problem, it's just recognizing that the problem is there and our previous attempts were unsuccessful other than creating economic distortions that this eliminates. Now, with a territorial tax treatment, even clearer that we face the problem of tax competition. It would be there anyway, but even more intense, because firms can report their profits wherever they want, given income shifting, and will have an incentive to report it in the lowest tax country. There could be some offsetting cost. There could be risk of putting all your profits in a country with an unstable government. And there may be some liquidity advantages to keeping profits in a given location. And because there's some illiquidity, then rates aren't driven to zero, but they've been driven through this competition to half the value they had a few decades ago. And they were cut dramatically in the US 2 years ago. And the trade-off a country faces in setting its corporate rate in this open economy context is if you cut the corporate rate, leave the personal rate unchanged, you're encouraging income shifting out of the personal tax base into this lower taxed corporate tax base, but you're hopefully pulling profits out of tax havens back into the domestic tax base. And you're trading off these two effects in trying to choose the rate. Whether countries are getting this choice right, I've not seen good empirical evidence to help judge that. The challenge is that you're not simply looking at what happens to the corporate tax base when you cut the corporate rate. Does enough profits come in from abroad to maintain revenue? Because you're also losing revenue from the personal tax as people take advantage of this low corporate rate to avoid high personal rates. But what we've seen through this tax competition is a dramatic drop in tax rates. And the US tax reform, while it makes no sense focusing on a closed economy setting, is entirely consistent with what we'd expect in an open economy setting, where we have expensing in order to avoid distorting trade and capital, and we're also subject to the same pressure, tax competition, and the same advantages from a territorial treatment relative to worldwide taxation. So I think that the US reforms make sense in this open economy setting, whereas they made no sense in a closed economy setting. Doesn't mean they solve anything. I mean, the large advantages to multinationals over domestic firms are still very much there, but there are, the response at least is understandable. Now, developing country context, there basically we have M equals 0, no personal tax. I'll assume that as countries start to get richer, they introduce a personal tax that affects a small slice at the top and gradually expand the tax base. But think about a setting without any personal tax. There we can't view the corporate tax as a backstop to something that's not there. And so the question is how the tax should be designed. Now the problem is that if we try to tax corporate income, same definition as we use in the US and Germany, then corporations avoid that tax by paying the money out as wages, rents, interest, royalties, and paying all the profits out, just reclassifying them as wages and paying them out. And so the question is how you maintain a corporate tax base when you don't have this taxation of money paid out under the personal tax. Now, various approaches can be attempted to try to protect at least some corporate tax base. One, well, yes, you can introduce a personal tax, but that's assuming we have a can opener. Another is to impose what are called scheduler taxes, payroll tax, equivalent on wage payments, an excise tax on interest payments, on rents, and royalties, or other forms of payouts. It's a complicated tax system because there are many names that can be given to these payouts, so many types of scheduler taxes. But even though they get a bad rap among tax economists, they are helping to lessen the distortions, the opportunities for income shifting. So that's one approach. Another approach used in the value-added tax is to allow a deduction only for goods that were purchased from a firm subject to tax. And then there's no opportunity for tax avoidance because the tax had to have been paid to have the deduction. And so in that sense, a VAT is protected from this type of income shifting and has a further advantage over the corporate tax that a tax is imposed on activity abroad. The tax is faced when the goods are brought into the country. Now, a third option is to not avoid any deductions, simply to tax a firm on its gross sales. I mean, then there's no opportunity for income shifting. And countries do commonly have a tax like this, called a presumptive tax, in lieu of a corporate tax. Generally, it's only for smaller firms with rules varying by country about when a firm would shift from the presumptive tax to an income tax. But the presumptive tax avoids these gains from income shifting. The trouble is when you have some firms subject to the very low presumptive tax base and a very large base, gross sales, and others subject to a high tax rate on their profits, then there are incentives to shift the expenses not deductible under the presumptive tax into firms subject to the income tax, and to shift your income into firms subject to the presumptive tax. So corporations subject to the income tax can open up small firms subject to the presumptive tax and have a field day engaging in income shifting. And I've seen stories like that in China as they initially introduced corporate tax. There was a recent paper by Michael Best and co-authors showing that presumptive taxes seem to do much better on efficiency ground than the income tax in their interpretation, because people evade the income tax, in my setting they could also as well shift their income to the presumptive tax base and their expenses to the income tax base. It's the presumptive tax base may avoid these opportunities, trying to maintain both problems. A few comments on directions for tax reform. Under current law, countries have been responding to tax competition by cutting their corporate tax rates. The U.S. has joined in this movement in an attempt to pull money back from tax havens, but at the cost of encouraging income shifting from the personal tax base to the corporate base. Corporate rates have fallen in half under this tax competition. That process, I'm sure, has not ended. I expect other countries will respond to the U.S. cut by cutting their rates further. And so it's hard to picture that the income tax can continue to serve the same role it has in the past, given this pressure. There's no floor to where this tax competition can go. So what are the alternatives? Let me come back to the VAT that I mentioned in developing country context. One advantage of a VAT is that the tax is the same regardless of whether the goods were produced within a corporate or non-corporate firm, is the same whether they're produced at home or abroad. And so this type of distortion doesn't exist under a VAT. There are other problems with a VAT. It's hard to tax financial services, to attribute where the goods are being consumed, but it has the advantage that it doesn't need the corporate tax as a backstop. Now, the same would be true if under the personal tax, the tax base were consumption. Labor income minus what was put into savings or plus what was taken out of savings. If we had that consumption tax base under the personal tax, then the advantages under the VAT would also be there under the personal tax. The tax is the same regardless of where the goods were produced, corporate, non-corporate, domestic, foreign. And so not only no need for a corporate tax, if there were one, is introducing a distortion because it's discouraging activity in the corporate sector that would otherwise be treated neutrally. So a shift to a consumption tax base, either through the VAT or through a redefinition of the tax base under the personal tax, can help with these problems. Now, we talked about an income tax, but if we look at the tax base in practice, a lot of savings is already treated as it would be under a consumption tax. In pensions, if you put money aside into a pension plan, it's not consumption, it's deductible. You take money out, it's fully taxable. That includes regular pensions, IRAs, KIOs, 401k plans, a whole bunch of these types of plans that are subject to these provisions, and that's a sizable fraction of overall financial savings. So we're probably closer to a consumption tax already than to an income tax. But the problems I described in this paper arise from equity held outside of pension plans in a firm one has connections to, where one can engage in this manipulation to save on taxes. And so the problems focused on here go away if equity held in firms one has connections to have to be held within a pension plan. Deductible when money is used to buy shares, fully taxable when money comes out. That way, rather than being taxed as capital gains when money is withdrawn, it's fully taxable. So it doesn't require a full shift to a consumption tax base. It's just the types of securities where this income shifting is common should be subject to a consumption tax. Now, I'm a theorist, but I can also put on the hat of a tax lawyer and say, well, yeah, that's fine. But we could then introduce something like a Roth IRA, where any money accruing within the account is never taxed. and put these corporate shares into a Roth IRA, as Mitt Romney did. He had millions of dollars in Roth IRAs, contribute $5,000 a year and come out with millions later. It's putting in money at $1 per share that is worth much more, and all the return is free of tax. So hard to claim that this is invulnerable to problems, but it's a direction at least to think about in future policy. I have further slides, but I'm way over time, so thank you.